Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video tutorial that we do here each and every night on the membership side of our blog. We're going to get a chance to go over both opening and closing trades today, but I wanted to actually talk about the coin flip. And you can see there's a little picture up here so you guys can just kind of visualize this as I go through it. But it's something that I've brought up a lot recently on the premium coaching that I've been doing with a couple of traders out there. And it's this concept that I really want to drive home, and it really kind of comes to fruition here at the end of the month. And so why does it come to fruition at the end of the month? And that's really because all month long, and for those of you who've been following along for many months and many years, you'll understand that we close out trades all during the expiration month, and we close out only profitable trades all the way through expiration. Now, this last week of expiration, we start rolling off some of the trades that were not as profitable. So some of the trades that were either just way out of the money or in the money or whatever the case is, we start getting rid of these trades, either rolling them or just closing them out flat out and taking a loss on them. Now, these trades obviously have a little bit of higher loss because we are one time closing them out versus rolling off a lot of profits throughout the month. And so how does this coin flip thing come into play? Well, I want you guys to just forget everything you know about trading for just 2 seconds and just follow the logic of the coin flip and probability trading. So if I were to tell you that a coin flip is heads or tails 50-50, everyone knows that, right? So if you were to only flip the coin 10 times, what is the likelihood that you would get heads out of those 10 times, right? Well, you might say it's maybe 5, right? It's 50% chance. So, okay, 5 out of those 10 times, you might get heads versus tails, etc. But in that case, there's actually a lot of studies that have shown that if you flip a coin 10 times, you actually get more of one or the other. So you might get 7 or 8 heads instead of 5 heads that you were predicting because it's a 50-50 shot. But if you flipped a coin 100 times versus 10, then you would probably understand that you're going to get more towards that 50% of the time flipping heads versus 50% of the time flipping tails. Let's take it to the even further extent and say, let's say you flip that coin 1,000 times. So now you're flipping this coin not 10 times, and there's no possibility of a streak of hitting a bunch of heads, but you're flipping this coin consistently 1,000 times. Then you are very likely and probably very close to 50.00001% chance of hitting a heads on that average over 1,000 times that you flip the coin. So what does this mean in trading? Well, what this basically means in trading is that if you consistently trade the same high probability trades over and over and over and over again, over time, you make enough trades, you will hit those probabilities. You keep your position size small, you make same high probability trades with volatility in your favor and choosing the right strategy, then over time, it's just a matter of time before the odds start to even out to where they should be, right? If you're making a 70% chance of success trade, you may have 3 losers in a row and start thinking to yourself, hey, this is a bunch of crap. I don't make any money with these 70% chance of success trades. But if you were to make 100 of those trades, I can almost guarantee that you have 70 winners and 30 losers, right? So that's the whole idea behind this coin flip. And so many people get this wrong, and that's why I wanted to go over it tonight in the video. So if you have any questions about this, or if you really like this, I'd love to hear your comments below. Add a shout out right below here in the comments section. Share this on YouTube, Twitter, Facebook, etc. Want to get this word spread out. So this really kind of applies to us tonight because we actually have, that's the pen, because we actually have some losing trades, and it doesn't look like April is going to be one of our winning months, right? We had a couple losers that really kind of tilted us over the edge in April, and while I don't really like having a losing month net of trades, this also means that over time, we still trade the same high probability trades. We're going to have months like this. We're going to have months where just the losing trades kind of outweigh the winning trades. And over time, and I've been doing this now for 7 years on this blog, I've consistently seen that it's these times right now where implied volatility is high, the market's actually rallying or selling off pretty hard. Now, this is exactly the prime time to be adding some great premium and to start leveraging our portfolios like we're starting to do for June and already for May. So really hope that the coin flip description here and kind of walkthrough really helped you guys just kind of get a better understanding of high probability trading. So many people just get it really, really wrong. So, all right, so let's go over some of the closing trades that we had here tonight before we talk about the opening alerts that we had for today. And today was a really weird day, right? The market was up in the morning and then it kind of fell all the way towards the afternoon. And then right before the close, just rallied right back up. So I do expect that we should see a little bit more of a rally off of the base here. We've kind of tested some lows consistently, and we're rallying off of those lows, which is good to see. All right, so the closing trades that we had here today, we bought back one of the sides of our EWZ iron condor that we had. And we kind of legged out of this one a little bit over the last week and a half or 2 weeks now. So we went ahead and bought back that call side that was in the money. It was actually pretty deep in the money, and so we paid almost full price for what the call spread was trading at about 198. And overall, after all the adjustments, we took a 156 loss on this position. So a little bit bigger of a loss on this position, but you can see EWZ has just really kind of blown through our strikes. Our strikes were at 44 and 42, which are about here. So there's no point in rolling our strikes because it's just so far out of the money. At this point, we just want to reset our strikes if we ever wanted to trade, or if we ever wanted to get back into this trade for May expiration. You just got to reset your strikes, take a loss on this one. There's only a $2 push at the end of the day, so you don't want to just risk it for $2 in potential profit. FXI is virtually the same. We had a broken wing butterfly that we traded in FXI, and you'll notice we traded the 33, the 34. We then skipped over the 35 and traded the 36. So this was a broken wing butterfly, and you can go back to that video tutorial as well. But we bought back that today for an 82-cent debit. Even though it says sold here, it's just kind of the way that the system put the tag in here because we sold it for a negative debit. So we basically bought it back for a debit. We paid money to get out of this. And at the end of the day, after taking a credit to actually enter the trade, we actually ended up with a $77 loss on this trade. So again, not a good trade for us, but again, at the end of the day, you just want to make sure that you're trading these high probability trades, keeping your trade size small. It was only 2 contracts on these, so it wasn't a big hit to our portfolio in the least bit. But you'll see that this just kind of went in the opposite direction of where we thought it was going to go towards expiration. The next trade that we got out of today is BBRY. So we had actually sold a 9-7 credit put spread, and this one was getting pretty close to being in the or out of the money in which we really wanted to be. So BBRY was kind of rallying here in the last couple days, but just kind of fell off the face of the map here over the weekend. And so we went ahead and bought it back early. This is actually going to turn into about a $2 Y debit. So we saved about 35 cents and bought it back at 165. And we took a 126 loss on this one. So a little bit bigger loss on this one, but it was a high probability trade that we initially put on, so I'm not too concerned about it. It was just really, really huge move that BBRY had. And, you know, it kind of tried to fight back here in the last week or so, but at the end of the day, it just kind of lost out and implied volatility dropped off the face of the earth. So after earnings, it was kind of really a no-show. We kind of thought it was going to rally back, and it did not. So that is what it is. The next one that we closed out is one leg of our price line. So the other leg that we have is a leg that's an out-of-the-money call spread. That will likely expire in the money, or I'm sorry, out of the money and worthless. So we basically factored that into our analysis here for the loss. But overall, after all the adjusting, we actually did a hedge on this price line credit put spread originally and went back in and sold the call spread. And so what we did is we created a big wide iron condor, and Priceline just continued to move down as it did with the overall market. So just bad luck and timing on that trade. But at the end of the day, because of our hedge, we were able to reduce our overall loss on this position down to 133. So that's actually not too bad considering we sold the other call spread above the market, I believe around a 177 credit or so. So that really helped reduce the loss by going in there and hedging this position. Again, you can see with Priceline, what really happened is that the stock just continued to trade lower all through expiration. Had a couple days where it rallied up, but really just no significant rallies and nothing on the horizon to suggest that we're going to get a big move in the stock anytime soon. Implied volatility is still very high, so we're going to start looking at this trade for May and June expiration. It's definitely going to be another one that we're going to go back to the well at. We've made money with Priceline before, and like we talked about earlier with the coin flip, it's just a matter of time before we make these high probability trades. I can't even talk tonight. And over time, those are going to start making winners more consistently than losers. All right, so those are the closing trades. So we'll get into some of the opening trades. Now, what you'll notice about the opening trades today is that even though the market kind of rallied up, all of these positions that we sold here today, these are all credit spreads, so they're all selling orders. And we actually took the call side of every trade here today. And the reason that we did that is twofold. One, the market still continues to be a little bit more weak. And even though it bounced off the bottom at the end of the day, it really wasn't a strong day for the market generally. And two, we already have a lot of put spreads that we've put on in the last couple of weeks. So I wanted to more balance out the portfolio heading into May and June. So you'll notice that all of these are also June expirations. So we're going a little bit further out, and that allowed us to get some really, really good premium across the board for these things and start adding some positions for June. So these are actually the first positions that we're adding for June, and June expiration, I believe, is about 60 days out or so. So this is a really, really good time to add these at great premium, and hopefully as implied volatility drops, we'll get a nice move in these things really, really quickly before we even get to June expiration. So the first one that we want to go over is Dow, DOW, and we sold the 49.50 call spread in Dow. So go to the chart here of Dow, and you'll see implied volatility is up at the 67th percentile, so really, really high. And we sold the 49.50, which is fairly close for Dow, but actually is a good distance away from where the market is. So Dow is actually one of those slower stocks that's just been actually moving very, very fast in the last couple of weeks. So even if this thing continues to rally, I expect it to continue to rally at a very slow pace towards our strikes if it does, and implied volatility will drop along with it. The next one that we got into is XLF. So XLF is the financials. That's the Spider Financials. They've been having a really tough time, so earnings hasn't been good. It's not expected to be good for a lot of financials. They're actually expected to have top-line revenue drops, and some of them see some significant profit drops. So we went ahead and sold the 22.23 call spread in XLF for a 25-cent credit, just shy of what we usually like to sell these call spreads for, around 30 cents. But that's okay. We're getting into this trade, and let me get the highlighter out of here. Getting into this trade with some really, really good premium and implied volatility. So you'll notice that the stock has continued to sell off, right? But then our strikes at 22.23, put it right up here. So we've got a pretty big window of opportunity here to make some money on this trade with our break-even price at about 22.25, which is right about here. Gives us a really, really good distance between ourselves and the market. So the market could rally up about another 4 or 5% here and still not even hit our strike. So that's really, really comforting. Implied volatility just above that 50th percentile, so that gives us a lot of wiggle room here to add to this position if we need to as the stock or ETF continues to rally up. If we could actually sell a little bit more of these at about 30 cents in credit, I'd actually be pretty happy. So a little bit of rally won't do us too bad. Now, the last one that we went into tonight is SPY. So this is one that we haven't traded in a while because SPY has been really, really low implied volatility and just recently had a nice jump in implied volatility. So a lot of people are adding protection, buying some puts, jumping up the price of all the options. And so what we did is we went to the 190, 193 call spread. So we're doing a $3 wide spread instead of our regular $1 wide spread. And the reason that we're doing that is nothing more than just to widen out the spreads, which uses up a little bit more capital per spread, and therefore we only had to sell 3 of these versus selling 7 of the XLF and 7 of the Dow. Now, with the SPY, it was really easy to widen out our spreads. Some of these other ones, if we try to widen out our spreads too wide, there would have been either no liquidity in that strike, so if we were looking at strikes that were much further away from the market, or the pricing would have been really bad. With SPY, because it's so highly traded, it was really, really easy for us to go to the 190 and 193, and I'll show you that here in a second on the trade grid. But it had high liquidity, the pricing was really good, so it was very easy for us to widen our strikes, sell less, you save a little bit in commission, and you just use up a better use of your capital. So by doing this, we sold that call spread for 60 cents in credit, so pretty good credit for that call spread, I think. And if we go to the SPY, you guys can see where our strikes at. Our strikes are all the way above the recent highs at 190 to begin with. So we've left a massive, massive gap for the market to rally. And if the market does rally, implied volatility has already dropped and is already in our favor. So if we see a continued move higher in the stock, then implied volatility for SPY will just drop like a rock. It'll be down in the 20s or the teens, which will really, really dry up premium in this particular call spread. So if I go to the actual trade tab here of SPY, just so you guys can take a look at that here tonight, and waiting for this thing to load. So we've gone all the way out to June expiration, which is about 67 days out for SPY. And let me just scroll all the way down here. All right, so here you can see our two positions on the left-hand side of your screen. So our first call was sold at 190 and our second call was bought at 193. Now you'll notice that the probability of being in the money for that first strike, because that's the one that we're concerned about, is about 20%. So there's about an 80% chance that the SPY does not rally above and close above 190 by June expiration in 67 days. So this is a 80% chance of success trade, about a 20% chance of losing. Going back all the way full circle to that coin flip, if we make this trade 100 times, 80% of the time we're going to be winners on this trade versus 20% of the time we're going to be losers. So as always, I hope you guys really enjoy these video tutorials. They're meant to help out, so I'd love to get your comments, your questions, your insight, your ideas. Add that right below to the comment section. Let me know what you think. I'll get back to all of those tonight or tomorrow before the open, and happy trading.